Hello, and welcome to our latest Money Masters podcast segment. I'm Mike Larson, editor-in-chief at MoneyShow, and today I'm speaking with David Rosenberg, founder and president of Rosenberg Research. David, thanks for taking some time out to talk.
Well, thank you for the invitation.
Great. Let's start with the big picture here. I mean, there clearly seems to be a lot of optimism, at least on the U.S. economic and market outlook coming from Wall Street, and a more guarded optimism, I guess I'd call it, in Canada, judging by action in the home market. Where do you think things stand here from a big picture perspective?
Well, I think what you've got in the U.S. Has been a frenzy, a speculative frenzy in the stock market, and it's not been based on the fundamentals. I mean, we know in the second quarter, the consensus is that earnings are going to be down 8% year over year, and that's coupled with an expected decline in revenues, showing just how much profit margins are coming under downward pressure. Look, at any given moment in time, the equity market is influenced by a whole array of factors, sentiment and technicals and valuation and fundamentals, market positioning, and momentum. And right now we are seeing a momentum-driven market, a market being driven by expansion in the price earnings multiple. It's not being driven by earnings, which tells me that the shelf life of this rally has question marks in front of it. So I think that, what's happening here is that people are fitting in the economic narrative into what the stock market is doing. And that's a pretty dangerous game to play. And I'll just tell you why. When I was chief economist of Merrill Lynch back over a decade ago, 2 decades ago, I was actually presenting at the Federal Reserve in Washington on October 9th of 2007. And I had a recession call. And the senior folks at the Fed laughed at me and said, Mr. Rosenberg, do you not realize that the S&P 500 hit a new record high today? That was in October of 07. And the recession that nobody saw coming occurred in December of 07. So, the stock market peaked in September of 2000, if you remember, notwithstanding what was happening in technology and dot-coms at the time. And everybody was there thinking a new era in equities, a whole new bull market, peaked September of 00. And the recession started once again, everybody was talking soft landing. The recession begins in March 2001. So I say, give me a giant break in terms of what the stock market is telling you about the economy. What are the commodity markets, which have been in a correction or bear market for the better part of the past year? What are they telling you about the economy? What is the US dollar, which is sliding away to a 15-month low? If everything is so hunky-dory, as you say, or as the stock market says, why is the US dollar being pounded over the course of the past several months? And of course, if we're into some brand new reflationary growth phase that has Goldilocks written all over it, why haven't bond yields broken out to the high side? What is the 10-year Treasury note doing at 3.8%? If the stock market is right, if the stock market has an economic forecast attached to it, I don't think it does. I think it's just purely investors are now, FOMO is now making its way back into the vernacular. And in fact, I saw somebody saying on CNBC that FOMO is here to stay. Tell me, is fear of missing out anything to do with economic fundamentals, or is it purely sentiment driven? But surely, if the stock market was screaming reflationary growth ahead, the 10-year note would be over 5%.
Yeah.
It wouldn't be a 3.8.
I saw that segment that you did on the Buck Stops here with Catherine Murray, and you were kind of asked this proverbial recession, no recession question. And I found it interesting that you mentioned that was the same question you had heard in years like 1989, 2000, 2007. Can you talk a little bit about the time lag issue and, when we can expect to see if this forecast is going to pan out, more negative news on the economy?
Well, look, the economy responds to shifts in interest rates in both directions with long and variable lags. We all know that. And when we see variable lags, it could be as short as 6 months or as long as 12 to 18 months. So it's not as if the central bank starts to raise interest rates on Monday and things start to fall apart on Tuesday. The economy resets to these high elevated interest rates with lags, and at some point it just cascades into an economic contraction. I mean, if I talk about a recession to people these days, it's as if I'm looking them in the eye and saying your kid is ugly. It's like, meanwhile, every recession is attached to an expansion. Every expansion is tied to a contraction. Thankfully, 85% of the time, historically, we're in an economic expansion. That's a great thing. 15% of the time, we are in recession. A recession is not a unicorn. It's not a fairy tale. They actually happen, and they happen 100% of the time, only 100% of the time, after these central banks raise interest rates to a point where they invert the yield curve. And we got a situation where the Bank of Canada and the Fed, they're not going to publicly come out and say we're going to create the conditions for a recession, but we just have to know the historical track record that you can get a soft landing in the economy when growth just miraculously slows once the central banks stop raising rates, once the yield curve flattens. Whether it's Tiff Macklem or whether it's Jay Powell, they are so consumed with grief and with guilt that they're not going to take any chances. To them, inflation is a tax on the elderly. Inflation is a tax on the poor. So if they have to crush domestic demand, which is what GDP is all about, it's about spending in the economy, to get inflation down and to stay down, they're willing to take those risks. And they have the political capital to do it. Nobody seems to be complaining. But the one thing I'm going to say about the recession is that, yes, I hear everybody saying, where is the recession? Where is the recession? Where is the recession? They were saying the same thing in 2007. I mean, the Fed stopped raising rates in the summer of 2006. And I was calling for a recession. Admittedly, I was way early. But I said there is no get out of jail free card when the central bank tightens policy into a curve inversion. And all throughout 2007, remember, the Fed stopped raising rates in the summer of 2006. And the recession showed up at the end of 2007. And it surprised everybody. Yeah. The same thing happened if you go back to the previous cycle. They said we just have a capital goods recession. It's all about technology. The recession started in March of 2001. The Fed stopped tightening policy in the spring of 2000. We still got the recession. Yeah. And no, people were calling for the recession. When they started calling for the recession? After 9/11, September of 2001. The recession already started in March of that year. So everybody, they think that they've got it all figured out because of what the quotes, the stock market is telling them. Recessions, they're like an odorless gas, They sort of, then they sneak up on you. But I'll tell you right now that if you're willing to say it's different this time, and that is a refrain that is basically paves the road towards financial hell, not evident right now. And I would say that the markets and most market pundits are gravitating towards this, quote, soft landing view. I think that we are in a soft landing. You see, we are in a soft landing. The question is not about the soft landing. The soft landing is the resting spot. The soft landing is the resting spot between the economy transitioning from the prior expansion to the future recession. So what people should be asking themselves is not soft landing today. Soft landing, we're in a soft landing. The question is, are we going to still be talking about a soft landing 3, 6, and 12 months from now? And the leading indicators are telling you that no, we will be talking about a recession 3, 6, and 12 months from now. And I'd rather spend my time trying to forecast what the headlines are going to be saying over the next year than talking about what the headlines were saying yesterday. And that's the trap people are falling themselves into, because nobody can look past the tip of their nose. It's rather incredible. And even these central bankers, they're focused on lagging and contemporaneous indicators. The leading indicators are pointing, I think, towards a recession that's going to start this quarter or next quarter, probably, and not later than that.
I'm glad you brought up policymakers and what's happening in Canada as well as the U.S. I mean, obviously the Bank of Canada just raised its overnight rate another quarter point to 5%, and Tiff Macklem had suggested more hikes are coming, which is certainly quite a different message than what the BOC was putting out back in January. And then you have a day like today where some of the Canadian CPI numbers are clearly decelerating. So I'm wondering what you see happening with interest rates. I mean, is this going to be a big reversal that we're setting up from here for in a policy perspective, or how do you see that evolving?
Well, I think that, I think you got to tip your hat to Tiff that although that they did go on hold for a short period of time, he made it very clear that getting down towards 3% inflation, from 8% was going to be relatively easy, given, the fact that supply chains have come back, that demand growth has subsided with a lot of the fiscal stimulus in the rearview mirror. We've had this period where, of course, lower energy prices have played a very big role. But he made the claim, and he may well be right, that going from 3% to 2% is going to be a lot tougher than going from 8 to 3. And the central banks are just stuck to the holy grail of 2%. I don't really know why. We did a whole report on this several months ago, showing that the sweet spot for the economy in terms of economic growth, vitality, stability, and not just in the economy, but in the financial markets, tends to happen more with inflation around 3% than 2%. And if you remember that in Canada, for a long time, really, before the 2%, I think when the Bank of Canada and the Finance Department, along with New Zealand, Canada was at the forefront of inflation targeting back in the 1980s. 3% seemed acceptable until it didn't, and now the 2% is the holy grail. And I'm not so sure why they'd want to sacrifice the economy to get to 2%. But this is what they want. I had Thomas Honig, who used to be the Kansas City Fed president many years ago, and he just basically took me to the woodshed on my own webcast for daring to say that 3% could be maybe the more appropriate objective. And no, they're stuck to 2%. So I'm a little worried. Look, I'm worried, number one, that the central banks, the Bank of Canada, the Fed, ECB is next, Bank of England, that they have way overdone it, that they basically have swung the pendulum from their transitory no inflation to now inflation's never going to go down. And we're going to swing the pendulum from these years of irresponsible, accommodative monetary policy with zero rates and balance sheet expansion. And now we're going to swing everything the other way. And we haven't seen the full impact. It took a long time, look at the past several cycles, even to get the economy out of recession. It took a lot of power in terms of lower interest rates and lags. Sure. And now to get to the recession, back heading into 2009, everybody's saying to me, "Where's the recovery? Where's the recovery? Where's the recovery?" Well, the recovery came starting in the second half of 2009. Now it's where's the recession? Where's the recession? Where's the recession? But you see, I think that secretly, these central banks wouldn't mind a recession. Unemployment rate up, get wages down, get inflation down, and to them, inflation is the greater social and economic disease. So what I'm saying is that the Bank of Canada is sounding very tough right now. Now, look, all these central banks, they can pivot. I mean, he's called Powell the pivoter. He's pivoted before. And my sense is that once they see the whites of the eyes of the disinflation, now you mentioned Canada CPI today, I think very encouraging. It's not as if there weren't some blemishes, and we know that the base effects are going to work against further declines in the inflation rate over the next couple of months. Yeah. But I think over the next year, inflation is going to be coming down quite a bit. And then how can we not talk about China? $18 trillion economy, second biggest economy in the world. The one thing we learned coming out of the great financial crisis is that there's no such thing as global decoupling. And China right now is basically deflating. And you don't think that's going to have a cascading effect on Asia, then on Europe, and then on North America. And it's just lags. Remember, it took lags from the US recession to the global economy back in 2008. Everybody talked about global decoupling. Talk about the craziest notion of all time. And basically it works in both directions. So I think that we got the combination here of China's going back in recession. The data sort of look like that, either that or some sort of stagnation. They are disinflating. That has a big impact on commodity prices. Commodity prices, the products in the CPI in the US, it's 40% of the index. Yeah. So right now, just take that and throw that into the dumpster, because we know that China's recession is going to drag commodity prices lower, and they've already been in a correction or a bear market for the better part of the past 6 to 9 months. And then you're going to get the rental components coming down as well. And that hasn't started yet. And the same in Canada. You talked about the CPI. Look at the housing start number in Canada today. It was 280,000 starts. It blew a hole through the consensus. Mm-hmm. It was the biggest increase of all time. And the biggest increases, by the way, were in multifamily. So that's going to help putting pressure on residential rents. So we're starting finally to see more of a supply response in the Canadian housing market. Well, that we need that, because the biggest source of inflation that the Bank of Canada is fighting is actually in shelter.
Got it.
So that's going to be something very important. So I think in answer to your question, they're going to raise rates one more time, maybe twice, Canada and the United States, and then I think we're done. So I think by definition, we're nearing the end of the tightening cycle. Then we're going to pause for several months. Then the central banks are going to see the whites of the eyes of the disinflation. Not just that, but we'll see the whites of the eyes of the recession. Recessions, by the way, are basically part of the business expansion. I don't want to insult anybody, but we are past peak growth, we are past peak rates, and we're past peak credit expansion, all leading towards lower interest rates over the next 12 to 24 months.
Yeah. Well, in the time we have left, David, let's talk a little bit about what that means for investor positioning and strategy. I saw a recent interview you had that you talked about kind of keeping a lot of money in cash because you're finally getting paid for it, in fixed income, looking at maybe the longer term end of the duration spectrum. And when it came to stock funds, you had some really interesting comments about why Canadian stocks could be a better play than U.S. stocks. I was wondering if you could expand on a couple of those.
Well, sure. Well, let's just talk about the Canadian situation here. The U.S. Ultimately, what are equity investors paying for? They're paying for an earnings stream, and I think, look, you look at the S&P 500. I mean, these are the best companies in the world, you could argue, but a 19 multiple. I mean, at what point, you're at a Sotheby's auction or Christie's auction bidding on a piece of furniture, an antique, or jewelry? At some point, you're going to stop putting up your hand. And a 19 multiple. When you think about the earnings yield on the U.S. stock market benchmarked against 5.5% risk-free rates, I mean, notwithstanding the fact that FOMO's back, you're not getting paid. You're not getting paid to take on the capital risk to be in the U.S. stock market right now, notwithstanding the fact that it's going up every single day. It reminds me of the clown of the circus, continues to blow up the balloon until it blows up in his face. Canada's a little different, right? Canada, the PE multiple is 13. We have been spanked. Everybody's been gravitating to the glories of the U.S. market, and maybe, and all the growth opportunities available in generative AI and the impact this has on semiconductors. I mean, Canada doesn't really have a whole lot of that. However, for index investors, 19 multiple in the U.S., I don't think so. Canada trades at a 13 multiple. So that's pretty rock bottom. And the banks are at rock bottom multiples. The banks are at levels that you actually historically want to buy them, and you get a nice fat dividend yield. You look at the dividend yield and the earnings yield on the Canadian stock market relative to the United States, much more compelling. In fact, the Canadian stock market is trading so cheaply relative to the US, it classifies as a 2 standard deviation event. So we've been telling, we have 30% of our clients are in Canada, 70% in the US, and we've been telling our American investor friends, cash in the chips south of the border, and move into the true north, strong and free. So that's a big part of it. In terms of what you said before, I'm very bullish on interest rates, and that means I don't want to have a laddered approach in fixed income. I want to basically own the front end of the curve. So I do want to have treasury bills. You're getting paid to wait, have the dry powder, but I want to own long bonds. Now, short-term rates are going to come down faster than long-term rates because the yield curve naturally is going to have to mean revert, and actually mean reversion means going to a positive shape, and the yield curve is positively sloped 85% of the time. So you want to bet on a curve steepener led by the front end, but I want to own long-term bonds because of the convexity and the positive total return that's going to come out of that. By the way, this is always the case of where your assumptions drive your conclusions. Look, if I'm right that the recession that nobody sees is actually staring us in the face, there's never been a time historically where long-term government Canada bonds or long-term U.S. treasuries failed to make you money. So I want to own the back end of the curve. I want to own bills, and within the equity market, I want to be screening on interest sensitivity. So that could be telecom, it could be utilities, it could be REITs. So stuff that has interest sensitivity in the stock market that is well priced, strong balance sheets, that's perfectly appropriate. I'm not telling anybody to go out and buy barbed wire and baked beans and canned tuna, but there are parts of the market that you can own in a recession, and they're defensive and they're rate sensitive, and that's what I would be gravitating into.
Well, David, I'm very excited that you're going to be speaking at the Toronto Money Show in September, and I'm sure that a lot of our listeners are going to catch what you have to say there as well. Any sneak peek you'd want to give at what you might share other than what we've already covered here?
Well, it's so hard to say right now. We're in July, September. Sometimes in the financial marketplace is a lifetime away. So, you'd be asking me this question in January of '09, and I'd be all bearish, bearish, bearish. And then it would have, but by April of '09, May, it was time to turn bullish, bullish, bullish. So it's going to be situational. I think that what you see is what you get right now. If the symposium was held tomorrow, what you see is what you get. But if the facts change, then your view has to change. If the stock market or the other markets start to price in my view, or overprice in my view, well, then I've got to think of something else to say. So I say, stay tuned. A lot of it's going to depend on what happens in the next 3 months.
Perfect. Well, again, thank you so much for your time, David, and thank you everyone who's watching or listening. I do encourage you to check out our upcoming Money Show Toronto program. We're going to be there from September 8th to 9th at the Metro Toronto Convention Center North, and it's going to feature 2 full days of keynotes, panel discussions, and more from experts like Dave. You'll find the details in the link below. And again, thank you so much for your time.
Take care.